Hi, my name is Makayla, and today I will be speaking on how recent global events such as COVID-19, technology changes, and the rise of big data have reshaped modern economics for better and for worse. Since the start of COVID-19, our economy faced the worst economic downturn since the Great Depression. This pandemic was primarily the cause of job loss, increased government debt, and major global market disruptions. Despite the bad, technology advanced rapidly, with artificial intelligence, also known as AI, and big data flourishing how many companies work, but also how the government makes decisions and how we can study society as a whole. Understanding these changes helps explain how today's economy works and what challenges we may face in the near future. First, we can look at the pandemic and its economic impact on society. During the lockdown, hundreds of millions of jobs were lost as global income rapidly declined. Governments responded with trillions of dollars in aid to prevent economic collapse. Two major scientific developments, COVID testing and vaccines, played an important economic role. Testing helped to reduce uncertainty by identifying infections early, while vaccines not only protected individuals, but also reduced the spread of disease, which benefited society as a whole. As restrictions were lifted, another challenge emerged: inflation. Consumers began spending heavily after months of limited activity, while supply chains constantly struggled to keep up. This led to rising energy prices to increase costs further. Central banks responded by increasing the interest rates in order to control inflation, but higher rates made mortgages and business loans much more expensive. Many civilians consistently criticized central banks during this time for failing to predict inflation. Economists, on the other hand, emphasize that forecasting is extremely difficult due to unexpected events such as pandemics or wars, which can quickly disrupt economic models. During the same time, big data revolutionized economic research. Economists now analyze massive data sets from tax records, social media, and satellite imagery to understand inequality and economic mobility better. Researchers reveal how children today earn more than their parents compared to past generations, and that neighborhoods have a strong influence on life outcomes. Forensic economics use data to uncover hidden patterns and wrongdoings. Studies revealed biases in judging, misleading advertising practices, and more based on unusual number patterns. Satellite data tracks economic growth by measuring nightlights, revealing whether countries accurately report their economic performance. Traditional economic statistics, however, are struggling to keep up with the modern world. Free online services provide value but are not fully captured in national accounts. Unpaid work oftentimes can be overlooked, although it significantly contributes to our society today.
So we're going to go over basically what happened during the pandemic and, just we know that there was economic troubles and this caused people to turn to the central bank, and they were already blamed before for their poor forecasting. Like, people thought that they should have predicted the pandemic to happen, which in my opinion is not right. I don't know, that just sounds kind of crazy, but they're mad, right? And this was added on to high costs, which I'm going to get into. So during the pandemic and kind of after it, there was a very high inflation in the markets, and there was a very high housing cost, and a lot of people turned to the central banks and kind of asked them like what's going on. And this is where the Tinbergen rule comes into play. Essentially what the rule says is that banks can only focus on one thing when they only have one tool. So for example, right here I have illustrated basically the only tool at the central bank's like disposal is interest rates. That's the only thing they can necessarily control. They don't control housing costs and inflation. Like, there's only one battle they can fight at a time, essentially, is what the Tinbergen rule states. So the importance of knowing the Tinbergen rule is that as much as it makes sense for central banks to basically solve anything to do with money, they really only have one tool at their disposal. And things like the pandemic, which were very unforeseen circumstances that really changed the whole world, it was not in the bank's control, and it was kind of unfair, I guess, to blame them for various different things. And it kind of just explains and sums up why, things like high housing costs were not solved immediately. Now moving on to a key mechanism that I noticed in the chapter, it was positive externalities. First, I'd like to define what a positive externality is. It's basically a side effect of production or consumption, and in particular, the positive externality I'm talking about has something to do with the pandemic. It was the COVID vaccine. Obviously, when the pandemic first came around, everyone was in quarantine, they were scared, and the vaccine kind of eased public tension and, kind of brought the world a step further to opening up again, since everything was shut down due to the virus. It's also important to note that the vaccine was free, which was mandated by the government, and it's kind of assumed that that was to prevent a monopoly and, one manufacturer selling the vaccine for hundreds of dollars when everybody wants it because, it's terrifying. It was at the time. And that was just one of the government intervention that we saw during the pandemic. So the positive externality I wanted to talk about was the consumers of the vaccine, who gained multiple benefits, but I'm just going to talk about two, which is the personal benefit and then the benefit to others, basically. So the personal benefit was that, if you catch the virus, then it's a little less bad to, go through that. And the second benefit was that, a lot of stores were closed to people who were unvaccinated, and obviously you're not gonna spread the virus if you are vaccinated, right? And it's less deadly to just have the vaccine. So here I drew a diagram of basically just summing up what I said and hopefully making it easier and tying in the real world to the economic policies that were going on and just how things were happening behind the scenes to try and help the world rebuild after COVID.
COVID and the economy. In early 2020, the emergence of COVID-19 shocked the world. Within just a few months, the virus spread across countries and continents, forcing governments to shut down large parts of their economies. Businesses closed, travel stopped, and people were asked to stay home to slow the spread of the disease. The economic impact was immediate and severe. Restaurants, hotels, airlines, and entertainment venues saw demand collapse almost overnight. Millions of people lost their jobs or were suddenly unable to work. Unlike many past recessions, which developed gradually over time, the COVID downturn happened very quickly and affected nearly every country at once. The government response to this was that to prevent the situation from turning into a complete economic collapse, government stepped in on a massive scale. They sent stimulus checks to households, expanded unemployment benefits, and provided emergency loans to businesses so that they could keep paying workers and avoid shutting down permanently. Central banks also played a key role. They lowered interest rates, stabilized financial markets, and ensured that banks continued lending money. These actions are meant to keep credit flowing and prevent panic in the financial system. Altogether, the government around the world spent about $10 trillion responding to this crisis. As a result, global government debt rose sharply. Before COVID, global government debt was roughly around 10 months of global income, and by the end of 2020, it had increased to about a full year of global income. Policymakers accepted this increase because they believed it was better to borrow heavily than to allow long-term damage to jobs and businesses. So my daily example of this is the FRED GDP chart. We can clearly see how serious the COVID recession was by looking at the real economic data. The FRED stands for Federal Reserve Economic Data, and the chart I'm using is called Real Gross Domestic Product with the series code GDPC1. This chart measures how much the US economy reduces over time, adjusted for inflation. When we look at the year 2020, we see how the GDP fell at an annualized rate of about 31%. This is the largest quarterly decline ever recorded in the US economic history. On the chart, the drop is sudden and sharp, almost like a cliff. This shows how quickly economic activity collapsed when businesses collapsed and people stopped spending money. This data helps us understand that the COVID recession wasn't caused by slow economic weaknesses. Instead, it was caused by an intentional shutdown of economic activity to protect public health. So a common misconception regarding this is that economists should have seen this coming. In reality, forecasting is extremely difficult. Most economic models are designed to track long-term trends like productivity growth, inflation, and population changes. They are not built to predict sudden shocks like pandemics, wars, or global supply chain breakdowns. A helpful comparison to this is weather forecasting, such as meteorologists predicting patterns, but they can't exactly know whether or not a storm will strike and where it will. In the same way, economists cannot reliably predict rare and unexpected events like COVID. So the inflation and interest rates after COVID. After months of restricted spending, households were eager to spend again. At the same time, factories and supply chains struggled to keep up with the demand. This mismatch caused prices to rise. Energy prices increased even more after Russia's invasion of Ukraine, adding extra pressure to inflation worldwide. To slow rising prices, the central banks raised interest rates, which helped reduce inflation but also made borrowing more expensive. This created hardship for mortgage holders, renters, and small business owners who had grown used to years of low interest rates. So my conclusion is that the COVID crisis showed how fragile the global economy can be and how quickly conditions can change. It also highlighted the difficult trade-offs policymakers face when responding to emergencies, balancing economy stability, public health, and long-term consequences like debt and inflation. Perhaps the biggest lesson is that economic policy must remain flexible, and crises don't always follow predictable patterns, and unexpected shocks will continue to test governments and central banks in the future.
Overall, modern economics is constantly being reshaped by global crises and rapid technology change. The COVID-19 pandemic highlights the importance of government policy, public health innovations, and limits of economic forecasts. At the same time, growing corporate power and algorithmic-based decisions raise concerns. Meanwhile, big data transforms how economists can study society, which provides deeper insight into inequality, opportunity, and human behavior. Overall, today's economy is more data-driven and interconnected than ever before. While technology offers powerful tools for understanding and improving the world, it also requires careful regulation and thoughtful policy decisions to ensure fairness, transparency, and long-term economic stability.